Hi, my name is Barbier, and today I'm going to show you my financial statement analysis of 3 companies that I chose. The first company I chose is Sanderson Farms. This is a chicken growing company. The second company I chose is Sony Entertainment. This is a technology company. They make TVs, cell phones, laptops, game consoles, stuff like that. The third company I chose is CF Industries. This is a chemical plant. Today we're gonna ask 3 questions. We're gonna ask which company would I give a short-term loan to, which company would I give a long-term loan to, and which company would I purchase equity in. The first question we're gonna ask is which company would I give a short-term loan to. For this, we're gonna look at 3 different graphs. We're gonna look at the quick ratio graph. We're gonna look at the current ratio graph, and we're gonna look at the cash ratio graph. Quick ratio graph. Well, the quick ratio measures the dollar amount of liquid assets available for each dollar amount of current liabilities. When looking at the graph, you can see that CF Industries in red is steadily decreasing throughout the 3 years. When you look at Sanderson Farms in green, they're increasing. And Sony Entertainment is at the bottom, and they're staying basically the same. Looking at this, you can see that Sanderson Farms is increasing while CF Industries is decreasing. This shows that they have more liquid assets available, and they're better. As far as this graph shows, they're better for a short-term loan. Current ratio is gives an idea of the company's ability to pay back a short-term loan. Sanderson Farms is throughout the 3 years is steadily increasing, while CF Industries is once again steadily decreasing. Sony Entertainment is at the bottom, and they're basically staying the same. Based on this, you can see that Sanderson Farms has a better current ratio, and this shows that they can pay back a short-term loan better, which is definitely good for this question. The last ratio we're going to look at is the cash ratio. Once again, CF Industries is decreasing throughout the 3 years, and Sanderson Farms is increasing. Sony Entertainment is once again at the bottom, staying basically the same. As you can see, CF Industries currently has a better cash ratio, but if you look at the trend on the graph, Sanderson Farms, I would predict is going to pass them up by next year. And based on these 3 graphs, I'm going to have to give the short-term loan to Sanderson Farms. And now we're going to look at which company I would give a long-term loan to. For this, we're going to look at the leverage ratio. Leverage ratio shows us if our assets is being financed by debt or equity. Looking at Sony Entertainment, they have a very high leverage ratio. This shows that they have a lot of debt. As far as a long-term loan goes, you don't want to give a company a long-term loan that has a lot of debt, because you're just going to add more debt, and it's going to be a prolonged process of trying to get them to pay you back. You have CF Industries, they're increasing, but they still have a low number. Sanderson Farms is decreasing, and they're even lower. Sanderson Farms being the most favorable company of the 3 for this graph. But for the question, which one would I give a long-term loan to, I would probably give both of these companies a long-term loan, because I think they could both pay it back. The third question is, which company would I invest in? For this, we're going to look at 2 different graphs. We're going to look at ROE, return on equity, and we're going to look at ROA, return on assets. Return on equity, ROE, is the rate of return for ownership and interest in common stock. Looking at this graph, you can see that Sanderson Farms is increasing. They're at the top, increasing all 3 years, or since the first year. And CF Industries goes up a little, and then they decrease. Sony Entertainment, on the other hand, is constantly decreasing, and they're in the negative numbers, which is bad. We don't want them to be in the negative numbers. For this graph, I would say Sanderson Farms definitely looks the most favorable. I predict that they're going to keep increasing. The next graph we're going to look at is ROA, return on assets. ROA gives an idea of how efficient management is at using assets to generate earnings. So this one, once again, Sanderson Farms is increasing and they're on top, increasing at a very rapid rate. CF Industries is decreasing, and Sony Entertainment is basically staying the same, but they're once again in the negative numbers. So this shows that they're not very efficient on using their assets to generate earnings. Sanderson Farms is obviously very good. They've increased a lot since 2013, and they're favorable for both graphs. So for the third question, I'm going to have to invest in Sanderson Farms. I hope that this gave a pretty good explanation on how you can use different types of ratios and different numbers to realize to make financial decisions in business. All these numbers were taken from the Bloomberg lab at Southeastern Louisiana University. Thank you.